On the EA exam, assume rental real estate is passive by default. That means a net rental loss usually can't reduce wages, interest, or other non-passive income. Instead, the loss is suspended and carried forward. It can offset future passive income, like profits from the same rental, or it can be freed up when you have a qualifying event, like a fully taxable sale. Here's the key contrast: active participation versus material participation. Material participation is the higher standard used to decide if a business is non-passive. But for the special rental loss allowance, you only need active participation. Think, you own at least 10%, and you make real management decisions, approving tenants, setting rental terms, authorizing repairs. A spouse's participation counts too. If you actively participate, you may qualify for the special rental loss allowance. Up to $25,000 of rental real estate loss can offset non-passive income, but it's income limited. The full $25,000 is available when MAGI is $100,000 or less for single or MFJ. Above that, the allowance phases out, and at high enough MAGI, it can drop to zero, pushing the loss into suspended carry forward. Married filing separately is where the exam tries to trick you. If you file MFS and lived apart from your spouse all year, you can get up to $12,500 of the allowance, but only if MAGI is $50,000 or less, with a phase-out above that. If you lived with your spouse at any time during the year and file MFS, the special allowance is zero. That's a hard stop. When losses are limited, they don't disappear. They become suspended passive losses carried forward indefinitely. Two big release valves show up on exams. 1. Your income drops enough that the special allowance becomes available again, so you can use current and prior suspended losses. 2. You dispose of the entire interest in the activity in a fully taxable transaction. Then any remaining suspended losses are freed up. Quick exam mindset. Always ask 3 questions in order. First, is it a rental activity? If yes, it's passive by default. Second, did the taxpayer actively participate, 10% ownership plus real management decisions? Third, what's the filing status and MAGI? Do we get the $25,000 allowance, the $12,500 MFS version, or zero? That sequence prevents most wrong answers. Darius owns one half of a residential rental house, and his cousin Elena owns the other half. The house is rented all year to long-term tenants. Last year, Darius paid $968 out of pocket to repair a broken water pipe on the property. How should he treat this expense on his tax return? Your choices include deducting it on Schedule C, deducting half on Schedule E, or deducting the full amount. Think about it. The correct answer is that Darius deducts $484 on Schedule E, his 50% share. Co-owners generally deduct expenses based on ownership percentage. If he paid more than his share, the extra isn't his rental deduction. He's essentially entitled to reimbursement from the co-owner. The tempting wrong choice is deducting the full $968 on Schedule E, but that ignores the 50-50 ownership split. Ethan bought a home for $250,000. $50,000 was land and $200,000 was the house. He later added a bathroom for $18,000. He moved out and converted it to a rental, with the tenant moving in October 1st, 2023. On that date, FMV was $310,000 total, $65,000 land and $245,000 house. He also paid $2,400 for plumbing repairs after the tenant moved in. What basis is used to calculate depreciation during the rental period? Think about it. The correct answer is $218,000. For a personal residence converted to rental, depreciable basis is the lesser of adjusted basis, or FMV, at conversion, using only the building, never the land. The house's adjusted basis is $200,000 plus the $18,000 improvement, or $218,000. That's less than the $245,000 house FMV, so $218,000 is used. The repairs don't change basis. They're generally a current rental expense.